Good morning, everyone, and welcome to Future Focus, the INN8 INVEST DFM quarterly review, and the last one for the year. Can you believe it? We're coming to the end of the year already. The Future Focus series is a series of webinars focused on understanding the world of fund managers and comparing and contrasting the best asset management skill, not only in South Africa, but in the world. And we cover the most important topics affecting investment management today. Just a reminder that the INN8 INVEST team was not only nominated for the Raging Bull Award for the Best South African Fund Manager earlier this year, we also just recently won the citywide DFM Overall Performance Award, where we competed against about 20 other DFMs in South Africa. So rest assured that your solutions are being managed by one of the best, dare I say it, the best DFM team in the country. As most of you know, we've been managing money for more than 2 decades now and recently changed our name from Standard Multi-Manager to INN8 INVEST. So same team, same pedigree, same track record. Our AUM just recently hit 45 billion at the end of October. So thank you for your amazing support so far, and looking forward to flourishing and growing partnerships. We've signed up many new advisor practices over the last few months since the launch of our new name. With so many of our new partners on the call today. So welcome, everyone. This just proves that our DFM proposition is indeed differentiated and adds so much value to our partners and their clients. At INN8, we pride ourselves around our investment pedigree, then our power, so the assets and the ability to negotiate really good fees on your behalf for the portfolios, and most importantly, partnerships with you, our wealth planners and financial advisors. Our role is to empower your practice by generating investment alpha, creating practice alpha, so that you can unlock even more advice alpha for your clients. And for those of you with co-branded or customized solutions, as you know, we've just been through your personalized investment oversight committee with your dedicated portfolio manager. So we have an action-packed session today, kicking off with Lubabalo Khenyane, portfolio manager at the DFM, fresh off a great interview of Asset TV. So check that out when you have a chance. And he'll give the latest performance overview of the INN8 INVEST core portfolios, which managed to deliver quite good results given the really tough market environments. So in August, we discussed the impact of the new Regulation 28 limits with President Truffle. While in this webinar, we'll be discussing how our managers in our solutions manage in times of extreme volatility and market drawdowns. And 2022 was one for the record books. My mind is in next year already. And so massive global instability, record high global and local inflation and interest rates, supply chain issues, Chinese uncertainty, all having huge impacts on the market. So the question is, how are our asset managers, very different views of the world, looking to create value for the investors given these very difficult market conditions? How do our managers navigate this volatility? That's what we're going to explore today. How do they navigate deep market drawdowns? So we'll unpack how both M&G investments and Abax investments have managed to steer their way through 2022. So I'm extremely excited to welcome Leonard Kruger of M&G, formerly known as Prudential, and Omri Thomas of Ned Group Rainmaker fame, and Omri's of Abax Investments. Both managers have been in the DFM solution since inception, and both have recently been nominated for their own citywide SA Manager Award. So well done to you guys. Then Joao Frasco, our CRO, will join the discussion and will end proceedings with a look at how we should not be greedy or fearful during tough market conditions and why it's important for your clients to stay invested. So just a little bit of housekeeping. If you have any questions, please feel free to pop it in the Q&A box. And we'll be providing or applying for CPD points for the webinar. So please keep an eye out for the notification. And then the webinar will be recorded and available in the next few days, along with the slides for the webinar. So let's kick things off. I'm going to introduce you to Lubabalo Khenyane, or affectionately called Lubabs, a portfolio manager at INN8 INVEST DFM. Lubabalo has 16 years of investment experience, and he started his career at Investment Solutions in 2006 as a portfolio analyst. In 2011, he transferred into the Investment Solutions investment team as an investment analyst, focusing on multi-asset class portfolios in South Africa and Namibia. Lubab's progress to become a portfolio manager in the global team, performing all typical functions of a portfolio manager, and he joined Standard Multi-Manager / INN8 INVEST in 2015 as a portfolio manager, focusing on various specialist collective investment schemes and multi-asset class portfolios. So Lubabs, welcome, take it away.
Okay, thank you, Leigh. Let me just quickly put up my slides. Okay, I think before I get into the performance of the models, it is important that I first paint the market environment under which those returns were achieved. The biggest driver of markets this year has been the higher inflation environment. I'm showing you the US in this slide, but this is the same for many countries. So if you plot this chart for Europe or you plot it for South Africa, you're likely to see the same trend of higher inflation and higher interest rates. Now, inflation started accelerating back in 2021, and at the time, it was thought to be transitory. And when we walked into this year, things got a bit worse at the beginning of the year. Remember, in February, the war between Russia and Ukraine broke, and that really sent up your energy and food prices, adding more to the inflation pressures that we started seeing in 2021. In the US, inflation peaked at about 9.1 in June before coming down to 7.7 in the most recent print. So on the back of this, the US Fed hiked interest rate from 0 to 4% in one of the quickest hiking cycles that we've seen in history. In South Africa, we've seen a similar trend where the South has also hiked interest rates, in fact, the most recent hike being in the past week. And on the back of the higher interest rates, then bond yields adjusted. And what we saw on the yield curve in the US was that your shorter dated bonds, the 2-year bonds in this case, actually went up more than your longer dated bonds, leading to an inverted yield curve. Now, an inverted yield curve historically means that there might be a recession that is on the cards, and that's really what the market has been grappling with here. And you would see that this was the case back in 2000 during the tech bubble, and it was the case again in 2008 during the global financial crisis. So the big question now is whether a recession is going to happen, and when it does happen, the severity of that recession. And that's really the one question that the market has been grappling with. And what we've seen is that every time the market believes that the Fed is likely to pivot, if that were to happen, if the recession happens, we've seen some good returns from your equity markets. This was the case in July, and it was the case again now in October, where your global equities went up 8%, domestic equities were up 5%, and property, albeit from an oversold position, shot up 11%. Fixed income assets didn't do as well in October, but if you look at the year-to-date performance, despite the recent performance that we've seen from your growth assets, you'll see that your equity and property markets, both in South Africa and offshore, are still negative. In fact, your global assets have given you negative returns of about 8 to 9%, even if you take into account that the rand is 15% weaker. So those returns are still negative, which means that they were worse in dollars. So that's really the environment that is prevailed. Now, we don't have control over what the markets do, but we do have control over the funds that we select and the funds that we put in the models. So, and if you look at the performance of those models, you'll see that all of them have outperformed their benchmarks in the year-to-date period. I'm focusing more on the year-to-date period here because that's when we started running live money on these models, and the performance has been anywhere between 30 to 250 basis points across the various models. And if we zoom into some of the positive contributors to that performance, in the flexible income model, Aluwani was the standout manager there. And what drove performance in that fund was their defensive positioning, no exposure to property, which means that 8% sell-off that you've seen this year did not affect their returns. Besides Aluwani, the 91 Diversified Income Fund also did well in that model. In the other four models, stable, moderate, high, and flexible growth, it was the Truffle Flexible Fund that drove performance. Now, in that fund, it's mainly been stock selection decisions actually by the manager that led to the performance. And if you look at some of the shares that they own, the likes of Tungela, which is up over 300% this year, really benefiting from the higher energy prices that we've seen. Also Glencore and Absa were some of the stock picks that the manager had that did very well. In moderate growth, again, performance being driven by Truffle, but the second highest contributor to performance there was Abax, the Abax Absolute Fund. And that fund is a low equity fund that we've put in a medium equity solution. So its equity content is kept at about 40%, whereas the category that the moderate growth fund competes in is kept at 60%. So by nature, in a period where your equities sell off, that fund is likely to perform well, and it did over the year-to-date period. And when I look at high growth, Loriam was one of the funds that contributed to performance. And in Loriam's fund, it was quite interesting because this fund has a very high equity content. It's been running an equity allocation of anywhere between 70 to 80%. And most of that equity, fortunately for them, it was SA equities, so good decision by selecting SA over offshore. But the stock picks was really what stood out in terms of their equity selection. And when you look at some of those stocks like the lives of an Absa and a Glencore, as well as BTI, I mean, Absa and Glencore are up almost 40% this year in a market that is down 2%. So stock selection was really the one decision from Loriam that actually added a lot to their performance. In the flexible growth fund, 361 Flexible Opportunity did very well. Now that category, the average manager holds about 67% in equities, and 361 was sitting at about 50%. Again, benefiting from the sell-off, and that 50% was also allocated to some good companies. And if we look at what we think is likely to unfold over the next couple of months, we think that the actions of central banks are likely to continue driving market returns, and the path of interest rates is going to be important. And the chart on the left shows you a picture of Mount Everest, and we think that if the path of those interest rate hikes resembles Mount Everest, that is a short, sharp peak followed by interest rate cuts, the markets are likely to continue running, and you're likely to see better performance and undoing some of the negative returns that were achieved in the first, second, and third quarter of this year. But if that path of those interest rate hikes resembles your Mount Everest, that is a higher interest rate environment for a longer period, then you're likely to have more of a sideways to a negative market, and we think that a recession in that environment would also prevail. But regardless of which one of these scenarios or any other scenario that plays out, we think that the funds that we have selected are managed by high quality managers. And we put those managers through our research process, and we're quite comfortable that they can negotiate uncertain environments as they have during the year-to-date period. Thank you.
Great. Thanks, Lubabs. Really great to see that the portfolios did well through a really rough time. Also good to see that some of the more sort of boutique managers really showing the value that they add in the portfolios, and then some of our larger managers also pulling through this really tough time. So thanks for that. So guys, next I'd like to introduce you to Leonard Kruger, portfolio manager at MNG Investments. So Leonard joined MNG Investments in October 2020 and is currently the joint portfolio manager of the MNG Balanced Fund and Inflation Plus Fund, SA equity and target income funds, as well as Namibian balanced and inflation plus funds. So lots of responsibility there for Leonard. With 14 years of dedicated investment management experience, Leonard spent the first 3 years of his career as an actuarial analyst at Liberty Life before joining Alan Gray as an equity analyst in 2007. During his investment career, he has covered a wide variety of companies and sectors. And in 2014, and that's I think when I first met Leonard, he started managing a portion of the Alan Gray Equity Fund and Balance Funds. And from 2015, a portion of the Alan Gray Stable Fund, that's across all asset classes, as well as all of Alan Gray's legacy segregated private equity portfolios. Leonard holds an honors degree in business science, actuarial mathematics from the University of Pretoria, and is a fellow of the Institute and Faculty of Actuaries. So welcome, Leonard.
Morning, Lee. Thanks very much. Thanks for the invite and for having us. Morning, everybody. Let me just quickly get the screen up. So I thought this morning just a brief introduction on sort of who we are. I think we're sort of 1 year into the journey now of having changed our name from the old Pru to MNG Investments. So a lot of market awareness needs to still be done by us, and in forums like this to just remind everybody who we are. What has changed and what has not changed. I mean, effectively, the name change from the Pru to MNG came about when our parent in the UK changed its strategy in terms of Prudential going more focused on the Asian markets in life insurance, whereas the asset management business in the UK and the rest of the world has really always been trading under the MNG banner. So last year we did a transaction, a very small transaction, where the PLC MNG increased their shareholding from an associate level to a majority owned, so 50.1%. And we think longer term, the opportunity and the strategy of aligning the business with a common name across the globe made a lot more sense than having at the southern tip of Africa a unique and different name. So I think one of the really exciting bits for us as an investment team at MNG South Africa is really with closer collaboration and a name that now gets associated with a global manager. It really stands to our clients' benefit if we can really leverage this global scale and expertise. So we have a substantial business here in South Africa, 280 odd billion rands of assets under management, and a healthy split between retail and institutional assets. But really, almost fortuitously, with the change in the Reg 28 regulations and the growing importance that international will have on clients' portfolios in the medium term, the ability for us as a manager to leverage and plug into an asset manager that has got a presence around the world, more than 100 years, 7 trillion rands of assets under management across all the familiar asset classes that we would be familiar with, so fixed income, property, equity, bonds, but also a great capability in terms of infrastructure development, private assets, and those kinds of products that in time we wish to make available to our South African client base as well. Clearly, being such a large manager, there's a great wealth of experience, and the company's got a couple of thousand employees, but over 550 investment professionals, 30 of us based here in Cape Town, and really the collaboration and the sharing of ideas and best practice, really plugging into that, and we're participating significantly in sort of the global forums. To not just give a South African perspective, but also, a broader emerging market flavor to our global portfolios. And then maybe just lastly on this to illustrate the scale and the number of clients and the diversity of clients that the business has. So there's been a name change, and there's been change in terms of our collaboration with our overseas colleagues, but very importantly, what has not changed has been the team that manages these portfolios and the way in which we manage these portfolios. So our approach, our philosophy, and our process has not changed. And that's always been sort of based on these three core pillars that you see on the screen. So valuation based, we think very deeply about the assets that we put into a multi-asset portfolio, whether that be equities, bonds, and the individual names that go into it. We're long-term orientated. We try to ignore the short-term noise, although being cognizant of the news and the development of potential future risks. And then I think what makes this discussion for today about navigating the, uncertain markets and drawdown so important is this third pillar that we have always been very, very focused on fundamentally in our approach, is to construct portfolios on a risk-conscious basis and being prudent in the way in which we try and achieve the various objectives of our clients, whether that would be a lower risk equity portfolio or a more classic balance type of portfolio, or even a pure asset portfolio like an equity fund or a bond fund. So maybe I just want to quickly touch on this, just on in terms of how you construct a portfolio on a risk conscious basis. So the first part really is, you need to go through the valuation and the debate and the decision-making process, but then how you actually decide as a portfolio manager, once you like something, how much of that to put into a portfolio goes through a very systematic process here at MNG. And there really are three levels of allocation. So a strategic asset allocation, so how we think the longer term best probability of achieving the client's objective of achieving some level of real return with the minimal amount of risk. So how much equities, how much bonds, how much property, how much local, how much offshore, those kinds of decisions. And then we take tactical decisions and allocations around that, how markets move and where these opportunities are. So if equities are particularly attractive, say, you want to go higher than the long-term average when markets are fair. And that is done by our multi-asset team, which I'm a part of. But then once we hand that over into the various asset classes, then we go and pick the specific security. So what are the specific stocks or the specific bonds that we hold in that asset class? And in each of these two instances, we do that on a very risk-aware basis. So we will build a portfolio not over-exaggerating a bet on a single name or on a single idea or on a single asset class. And that's a very critical part in how you then actually manage your risk in portfolio construction. Once we've put all of this together, clearly you got to look at the end product. And there are so many varied ways in which one can monitor, control, and review these portfolios, whether that be by style versus the amount of risk. We run very detailed quantitative models to see where tracking error, volatility, risk of drawdowns, where those risks come from. And that doesn't necessarily mean that we need to change the portfolio, but it is a great enabler for a portfolio manager to actually just have the awareness as well as that independent control of where the risks in your portfolio lie. We also look at our peers, where their movements are, what they're doing, and adjust our portfolios accordingly if the risk relative to the market or to our benchmarks become outside of the tolerance. Very important always naturally to emphasize is the human overlay over all of these processes. So none of this is mechanistic or computer driven. The human overlay and the human judgment factor is very important, and clearly this is a iterative process that we do on a daily basis. This is my last slide, maybe just for context in our discussions a little bit later when we talk around how we positioned our portfolios and why the experience of this year and the medium term has been what it is. We view South African assets as particularly attractive, offering very attractive prospective inflation beating returns in excess of what we think a long-term fair value for these assets are. Offshore assets have looked quite unattractive for us for quite some time. This year has been tough, as Lubabs have highlighted, and those valuations are starting to improve. And that's really where we have taken quite a bit of active action on our portfolios. But we'll get into all of that during the discussion. So Leigh, let me leave it there. Thank you very much.
Thanks so much, Leonard. I mean, from Prudential to M&G, I mean, one thing I can say is that everything has stayed the same from a philosophy and process except the name. And what I took out of that was sort of valuation-based, long-term, and prudent, Leonard. So thanks for that. We'll chat a little bit later. So next, I'd like to introduce you to Omri Thomas. I'm sure many of you know Omri. He's a director at Abax Investments, and probably in my mind, one of the industry legends out there. Omri Thomas is a director at Abax Investments, where they oversee assets of around 90 billion rand. He's the lead portfolio manager of the Net Group Opportunity Fund. That's a medium equity balance fund, as well as the Amplify Flexible Equity Fund. So that's the SA Flex Fund. Both funds rank in the top decile of the respective categories over the last 1, 3, and 5 years. Prior to joining Abax, Omri was the Chief Investment Officer of Sanlam Investment Management, and Omri is a chartered accountant and a chartered financial analyst for CFA. Welcome, Omri.
Good morning, Leigh, and thanks for having me.
Pleasure.
Thanks for the opportunity. So what I thought, I'll just give you a quick rundown of who Abax is, and then just the funds that we run, and a quick overview on where we are in the market. So Abax is a company now almost 20 years old. It's fully owned by staff, 3 charitable trusts, and 25% by AMG, which is an international US listed company that just invests in asset managers. So it's very useful to have them as a partner. So just on the next slide, thanks, Simon. Just our asset under management, as Leigh said, we had about 90 billion. We outsource most non-investment related functions. So our staff complement is only about 25, and we try and focus on getting investment performance. About 60% of our business is non-equity, with about 40% in equities. On the next slide, just a track record, and why I show this, these are all building blocks that we also use in constructing our multi-asset portfolio. So it's very pleasing to see that on all our mandates since inception, we've managed to outperform both the market and our peers on average by about 2%. And I think that's very helpful also when you construct a multi-asset portfolio to have these building blocks to build it with. Next slide, please, Simon. So just quickly looking at the track record of the different mandates that we run. The first is the Abax Absolute Return, so a low equity balanced fund where we try and achieve no negative capital returns and inflation plus 3 to 4. And it's very pleasing to see that on all the investment horizons, we either in the top quartile or decile. So very consistent performance over time. On the next slide, you can see what it looks like through time on a rolling 1-year basis. And very pleasingly, in a very difficult time when COVID hit, you can see that the fund still managed to achieve a decent return, whereas the median low equity balance fund actually went negative over a rolling 12-month basis on that basis. So the next one I'd like to show you on the next slide is just the risk-adjusted return. So it's one thing to get returns, but how much risk was taken to that return. So on the horizontal axis, the Sharpe ratio, so that's your unit of risk, return per unit of risk, and the vertical axis, the return. So you want to be on the far right-hand side and as high above as you can. So it's pleasing to see that our fund is in the top right quadrant where you want to be. The next slide is just the track record since inception. You can see how it compounds as you continue to outperform. This is our high equity balance fund, and we can see even though it's about 2% per annum over time, it does add up to quite a significant outperformance. Again, if you look at the next slide, just a on a different terms. Again, top quartile / decile over all investment terms. And then just the last one on this, again, the risk-adjusted returns, again, in the top right-hand quadrant. The next one, please, Simon. This is the opportunity fund that we run, and also the very far to the right and above, so same profile. And I think what's pleasing to see here is just the asymmetric return profile. So we've managed to capture 48% of the upside, whilst only capturing 31% in the downside. And since inception, that's enabled the fund to both outperform. If you look at the next slide, it's managed to outperform both the market and low equity, medium equity, and high equity average. Since inception, the fund's delivered 10.5% per annum versus the all share of 10.3. So you've managed to beat the market at less than half the market's risk, which we're quite pleased about. Thanks, Iman. Next slide. So how did we manage to achieve that? So the marketing is over. So what do we do to get there? So we've got fair value models for all the asset classes, and we try and leverage the Abax security selection across the capital structures to obtain those returns. So we start with a portfolio construction and try and understand all the drivers of risk and return. So we want to optimize the amount of return that you get per unit of risk. We try and diversify across geographies, asset classes, industry styles, and individual securities. And then where we think there are specific risks, we put hedge overlays on it. The next slide. Sorry, next slide, Simon. Thank you. So the toolkit that we use, we've active asset allocation, security selection, hedging strategies, hybrids, duration and yield, and then portfolio construction and the diversification. So you want to use as wide as possible a toolkit to enable one to achieve this. So just to look at some of it on the next slide, Simon. Yeah. Okay. So I think we've Leigh. Sorry, I think we've dealt it in detail. So maybe I'll just go back to you for questions.
Absolutely, and we're going to dig into a couple of more things a little bit later, Omri. So thanks for that. So I mean, Omri, from what I get, I mean, what you guys have managed to do over the years and why we like to include Abax in our portfolios is that asymmetry in return. So and using sort of that wider toolkit to achieve that. And just for the audience to know is that Abax only allows certain partners to make use of their funds, of which we are one of them. So you can access the Abax Absolute Fund, particularly is one that we use in our core portfolios, in our model portfolios. So I'd like to invite Leonard back and Joe to have a quick discussion around what's happening out there in the markets. Right, I'll introduce Joe a little bit later in terms of his CV, but let's get stuck into it. Right, so Omri, have you in your career experienced these levels of volatility and just like high frequencies of deep market drawdowns as we have, since the start of COVID? Maybe let's just put the last 3 years into context relative to other periods that you've been running money.
Oh, Leigh, thanks. It's quite a good question, and obviously the recent history is always the most vivid. So one don't remember the past drawdowns and the past volatility, but I think what we've seen is because of sort of almost global monetary policy dislocation that's exacerbated the moves that we've seen. But we've seen that in the past. I started in the markets in 1998 and in July 1998. My second month in the market was August 1998, and by the end of that month, the all share was down 30% in 1 month. So I mean, we've seen these extreme moves and extreme volatility before, but it is quite vivid and it is quite extreme at the moment. And you see massive intraday volatility. You see massive stocks like Naspers moving 40% in a month. I mean, that's a major cap share. So it's incredible to see. I mean, similarly in the States, you've seen some of these high market cap tech stocks just getting hammered. So I think the volatility is as extreme as it's been in past periods.
Cool. Thanks, Omri. We'll dig into some of those tech stocks a little bit later. Leonard,
as Omri was saying that, I was just thinking how hardened I think we as South African investors have actually become. You know, given some of the local events that we've also had to navigate at the same time as these global you know, change in regimes that we've witnessed. So I think there was a stat a while back that said, you know, a certain proportion of international asset managers has actually never actually lived through a recession or through a market drawdown, which clearly for us as South African investors is not the case. So we've earned our stripes perhaps a bit more than some of our international peers.
Absolutely. I think we've maybe had more than our fair share of difficult moments in SA. So Leonard, just on, you know, positioning, and especially how you guys were positioned going into COVID-19 in that drawdown period, and you subsequently recovered quite strongly. But is there anything that you would do different to protect for future market drawdowns or future drawdown risks? Sorry.
Yeah. Thanks, Leigh. I suppose, I mean, maybe just for context for the audience, going into COVID at the start of 2020, our multi-asset portfolios were more risk asset weighted than probably would be the norm. You know, the valuation signals were attractive. The South African market hadn't gone anywhere for a long time. And I mean, really then, you know, as we all know, the pandemic came about really, really quickly, and the drawdown was severe. I suppose, I mean, one of the big lessons from that has been that, you know, credit to the team that we didn't capitulate on any of the bigger calls in the portfolio. So you didn't have that permanent destruction of capital by switching out at the bottom. So those awareness of those behavioral risks was sort of, it was there, but it was amplified yet again and brought into the DNA. And the drawdown was luckily very, very brief. The funds recovered very strongly because of the holding the conviction in some of the entities. I suppose, I mean, one of the really big lessons has been to you know, be even more prudent when you manage liquidity in your portfolios. Be even more aware of having ammunition and capital to deploy when you get these really extreme drawdown scenarios, to actually not just, you know, be able to hold the line, but actually to lean into opportunity that presents itself. And so I think with the benefit of hindsight of that crisis, you know, we were able to hang on to the positions, but perhaps we weren't as ready to continue leaning into these favorable opportunities that presented themselves. You know, and future drawdown events will have different scenarios, and there will be different reasons why it happens. So, you know, one needs to look at that scenario, but actually genericize it, to enable you to be able to think clearly and act when the next event comes to pass.
Cool. Thanks, Leonard. Joe, so I mean, our job is to select what we believe are the best managers out there for specific jobs in our portfolio, right? So, you know, maybe can you help us understand sort of what we're looking for from our managers, specifically in these difficult type markets?
Yeah, great. Thanks, and good morning to everyone. And you know, maybe just to sort of go back to your comment about the awards that we won them because of these managers, right? It's our partners. You know, we're not out there picking stocks and bonds. You know, we're giving that task to managers that we think are really good at what they do, and we can unpack, you know, why we think that. And they've delivered that for us, so we wouldn't be able to do it without them. So it's a big thanks to them. And also congratulations on them winning their own awards. So they're winning awards for themselves and for us in the process. Look, the simple answer is really that all we want them to do is exactly, what they said they were going to do. So we spend countless hours with managers, over many, many years. I mean, we've seen M&G and Abax, over certainly the last decade that I've been at Stanlib INN8 INVEST now, we've seen these guys over and over again. And, we need to unpack their philosophy and process and understand how they think about, building portfolios, not only when markets are going up, but when markets are going down, when markets have low volatility and when markets have high volatility. So all we're wanting is to have no sort of surprises, because if we're surprised, then either we failed at our job, in understanding these managers, or perhaps, they failed in communicating exactly what they're going to do. And that's really the case. I mean, that, never happens. So, these managers spend a lot of time thinking about, and Leonard mentioned, having these years and years in the market, Omri mentioning over sort of 25 years in the market, they've been through these cycles and they know exactly the way they're going to manage money. It's not that there can't be evolution of processes and philosophies at the margin. Leonard spoke about sort of lessons learned and everything else. You certainly want to allow that. You want to allow great managers to become even better. But otherwise, no surprises. Do exactly what you said you were going to do every time that we met with you. And already a special focus on understanding, how they're going to manage money through these difficult times. Because we put ourselves out there to the advisors and investors to say, you don't need to worry about this. It's going to be the theme, that I speak about later about greed and fear. You don't need to worry about that, because we've got managers that worry about that, and we worry about that. So the message is really simple. Don't give me any surprises. I don't like surprises. I want you to do exactly what you said you were going to do. That's why we picked you. You play a special role within the portfolio. And if you just deliver on that promise, our portfolios are going to deliver on the promise that we set out to deliver for advisors and investors. Thanks.
Awesome. Thanks, Joe. I mean, the message there is that every manager has a role to play in the portfolio. When we construct portfolios, not just sort of a random mix of managers. Everyone has a job, and we expect them to do a certain job over a specific sort of market environment, or in a specific market environment. Thanks, Joe, for that. Leonard, it's often said that all correlations go to one during a market correction or crash, which is obviously not true, right? But explain how M&G would identify a stock that provides a little bit more protection during these large drawdown periods.
So I suppose, I mean, we're fortunate in that we have the resource both in South Africa and internationally to really know the companies that we invest in. We've got experience. We've walked with, the way in which you've walked with managers, we've walked a long journey with a lot of the companies that we invest in, right? And so you have a very good sense of sort of the classic quality of the quality spectrum of businesses that are available, businesses that are more prone by its very nature to be cyclical. Think of sort of a retailer or a casino company versus the classic sort of sin stocks that would be more defensive. So you need to understand the business cycle of and how that impacts all of these businesses. Clearly, we need to be on top of our game when we think around the financials and the fundamentals of the accounts of these businesses. How deep is their resources, their balance sheet structure, and their competitive position. So really the classic quality factors become quite important, but then also to understand where you are in the cycle with, when you want to be in specific kinds of names because of their competitive advantage, the moat around the business, and perhaps its financial strength.
Great, thanks for that. Omri, you mentioned earlier in your talk that Abax really uses or tries to use as wide as an opportunity set as possible manage in sort of rough markets. So my question is, how important are derivatives to the way that Abax manages risk and volatility, and how do you balance the cost of protection with those potential benefits? Maybe give us an example of that in your portfolios.
Yeah, Leigh, I think that's an important question. We do see that as a very important tool to use. Now, mostly, if you buy insurance on your house for against fire, you never hope to be able to claim against that insurance. But when you have that insurance and that event happens, that is you're very glad that you've had that. So that's the way we look at derivatives and hedges. And then what we see, what we say, is there a way that we can reduce the cost of that insurance impact on the portfolio? So there are various ways to reduce the insurance. If you think of your excess that you pay on a car, one can do a similar on hedging on a stock. So you maybe don't hedge it from immediate levels, only for slightly lower, and that lowers the cost. Or you can say, well, to pay for that insurance, I give away a bit of the upside if the share should run, because your concern is that the share actually falls. So, and by giving away some of that upside, you use that to pay for the hedging. So we try and minimize that cost, and typically we've been able to reduce the cost on average to below 0.5% of what you're actually protecting. So our premium that we spend is typically on average about less than 0.5%. So we think it's a very cost-effective way to get insurance against the sort of extreme events.
Great, thanks. Leonard, what's your view on the use of derivatives in portfolio construction and particularly risk management?
Yeah. Look, I don't disagree with what Omri is saying. In reality, though, it is something that we have used perhaps less frequently than some of our peers in terms of managing the risk, because like I tried to show in those couple of slides, the initial construction of the portfolio is so risk aware. So we with overlaying another layer of protection or through derivatives, it really isn't something that we use on a perpetual basis. But there have been examples in the past. That specifically talks more to the domestic market, where also sometimes, in terms of the depth of the capital markets are not as wide as they would be, say, in the developed markets. So in the offshore components of our portfolios, we do tend to use it a bit more in terms of our offshore portfolio construction. And then locally, what we've typically mostly done is if you want to move your portfolio a bit quicker than actual trading in the market, so using futures or forwards for either currencies or market exposure would be the typical. So we try to keep it simple. We don't use anything too exotic, and we don't use it as a standard tool in our portfolios on a month-to-month, week-to-week basis.
Great. So clearly already a difference between the two different styles of management. Then, Omri, do you manage your portfolios differently during market volatility or sort of oscillating markets versus when the market is in a deep drawdown? Maybe give us some insights as to what you guys do in those two different types of environments. And maybe, or do you have a different mindset in those environments? Do you manage differently? Maybe some insights there would be great.
Yeah, thanks, Leigh. I think it's a good question. Our first principle is always, what is the return opportunity that the market presents yourself? So typically, if you in a market where there's been a deep drawdown, your pool of potential good returning opportunities is quite wide. So typically in that environment, we would be looking to increase our risk exposure, to increase our equity exposure, to increase our exposure to high quality companies that we think have been oversold. So it's a bit swimming against the stream, and sometimes you can be a bit too early. But you think, if you think if this is a long-term game, and by buying those companies at those levels, you're able to lock in good long-term returns. Maybe you could have done it a bit lower, but you can do it. Now, you do get markets where valuations on average are closer to fair. And then that's where you refer to sort of these oscillating markets, where it's oscillating around maybe a fair value. And in those markets, you'll typically be playing a rotation game, selling some of the companies that have become expensive and rotating it back into something that's cheaper. You'll probably keep your exposure on a net basis at the same level, but constantly trying to rotate the portfolio into better yielding opportunities.
Okay, so almost like sort of using a cricket analogy, in oscillating markets, you'll probably be batting for ones and twos, while in sort of deep drawdown markets, you're positioning to sort of hit a big six, hopefully with some of the opportunities there.
Spot on, yeah.
Awesome. Right,
and
Leonard.
There aren't a few fielders in the field that catches you.
Absolutely. Leonard, what's your take on the level of geopolitical risk right now, and how do you manage for that in your funds, if at all?
Yeah. Look, I mean, it's I don't think it takes a special insight for anybody to make a statement that the geopolitical risk is perhaps higher than it's been for probably the last 30 years, basically since the fall of the Soviet Union. We'd sort of been on a geopolitical terms, we've been in a similar sort of regime. I suppose that from managing a portfolio point of view, I think we acknowledge the fact that we are not political analysts or political scientists, and that politics is even more unpredictable, because the behavior isn't necessarily rational from just an economics point of view. So we try to have an awareness of the political events that are forming the risks that introduces, whether that would be Russia to Europe and sort of the energy implications thereof, or future potential risks where clearly the likes of the competitive positioning between the US and China is becoming an increasingly important element that keeps markets worried and aware. So really what we try and do is we try and be aware. We don't try and make a prediction on how politics will play out, but it's very clear to us that you need to incorporate that in part of your risk monitoring system. So if you are doing your valuation fundamental work, trying to sound out the noise, and you come to the decision that Taiwan semiconductor is a fantastic opportunity, and you want to build a massive position in Taiwan, your risk controls need to actually be able to flag that and say, listen, you've got a lot of exposure to Taiwan, and there's this risk, and control that risk thing. It doesn't mean that these companies or these countries are automatically uninvestable, but you need to be very aware of the risk, because I think the experience that the whole world has woken up to this year with the geopolitics of the Russia-Ukraine situation is that permanent impairment of capital of people that had investments in Russia. That's very hard for portfolios to recover from those kinds of drawdowns.
All right. Thanks, Leonard. I'm going to pose a question for actually all three of you, maybe just to give your views. Joe, you included. So, I mean, it touches a little bit on last quarter's topic, but I'd like you guys' view on it as well. So, Reg 28. So there's a greater allowance for offshore exposure now, and a greater opportunity set for investors to access broader market opportunities, right? So a bit of a sort of a nuanced question. Firstly, does this new opportunity set mean that we should just rush out and just maximize that 45%, and maybe just your views, Leonard and Omri, on that? And then also utilizing that opportunity set, is it important to actually be resourced and staffed offshore, or are there other ways of doing it and leveraging that opportunity from South Africa? Maybe Joe, you can start with you just on your sort of view from our perspective, and then I'd like the rest of the guys to give comment.
Yeah, thanks, Leigh. Look, I mean, I guess I have a bit of a unique perspective because I spent a couple of years as an asset consultant and thinking about the liability side of the investment equation, right? Asset managers typically don't have access to, either the pension fund that's their client or, retail investors that are their clients, and they can't possibly know every single person's requirement in terms of their risk appetite and, the currency that their liabilities are denominated in and investment horizon, all of these sort of things, which are clearly very important if you wear that mindset. It's often referred to as an optimization exercise of surplus, which is assets less liabilities. Whereas often as asset managers, and I'm now put myself in that sort of role, I can only focus on the assets if I don't know what the liability side of the equation is, right? So what we do is include liabilities when we're thinking about South African investors as having this Rand denomination. Now, it doesn't mean that they're 100% Rand denominated, because we know, we can see this through the inflation experience that we're going through right now. High oil prices will affect us in South Africa. It doesn't matter that oil is priced in dollars, it's going to have an impact on South African inflation. So there's an element of imported inflation, and South Africa experiences this to a greater extent than maybe, certainly many of the developed countries. So if you think about it in liability terms, what you end up with is in the optimization exercise that it tells you not to put the full 45% offshore, even though that's allowed. In other words, if you think about the liability part of the equation, the optimization, and it is an optimization exercise, is going to tell you that you should have less than that. Now, clearly for an investor, for example, that plans to retire in Europe somewhere, their liabilities might be euro denominated and they could have a much bigger allocation. But now if we separate the asset allocation sort of currency decision from the underlying stocks, you should argue that actually most people should probably have 99% of the assets invested offshore. And then you would hedge back that currency to whatever that optimal number is. So call it between 30 and 40% is probably where that range sits. So you've got to separate out those two things. And we've seen, some of the asset managers that will want to take the full 45% and then hedge back the currency to that optimal number. Whereas other managers, maybe not thinking about the liability side, or perhaps they know their client base is more sort of, globalized and might have, liability sitting outside the country, and therefore they want that allocation to be much higher at 45%. So it's not about this, a right answer. There's probably a best answer for each individual institution or retail investor. But, what we try and do at product level or solution level is try and match it, in the broadest sense for, a South African investor.
Great. Thanks, Joe. Omri?
Yeah, it's. I think Reg 28 the changes have really enhanced an investor's portfolio to optimize returns and at lower risk. So previously, when the limit was 25%, that wasn't really a limit; that was a target. Because as Joe said, if you optimize, the optimizer typically would have resulted in a value that is higher than that 25%. So you almost ran at the full 25% limit. Now with 45%, it's increased your ability to take an active asset allocation decision. So just like Joe said, this has enhanced your universe from 140 stocks on the JSE to 8,000 global listed stocks. So surely one should be able to find better stocks offshore. And that's what we've seen in our portfolios. Our ratio between local versus offshore stocks have shifted towards offshore. And then separate to that, we take a currency decision to say, and I mean, in the past, the currency has been one way. You've just seen a depreciating Rand, so just as much as you can offshore. But in the last, call it 5 to 10 years, we've seen 2 or 3 times where there's been significant Rand strength. Now, if you've got too large a portion of your portfolio offshore, that's a big bet, one-way bet that you've got. So, and in addition to that, your domestic equities, a lot of them are rand hedges as well. So that doubles up on your foreign exposure. So we first construct a portfolio and then take a separate currency to the decision to actively target a level of FX exposure that we want. And because we're in South Africa and we've got high interest rates, that hedging actually doesn't come at much of a cost. It's actually a small benefit because you lock in higher than current levels if you use currency futures to hedge your FX exposure.
Great, thanks, Omri. Leonard, does M&G have a competitive advantage with having a team out in the UK?
Well, Leigh, we like to think so. Like I showed on that first chart, to have 550 people across 8 offices looking at various asset classes, the reach that we are able to get to in terms of the number of securities that we're able to do the fundamental work on, and then hence get at this funnel of ideas to our appropriate portfolio managers to construct the portfolio in line with the objectives that we would seek for our clients. We think that is a serious competitive advantage for our business and for the South African clients that are invested in our portfolios. So, we're doing lots of work around, integrating our team into more of the meetings to just get a sense of sort of the ideas bubbling up from the bottom up, but also to make sure that the portfolio managers and the analysts that we speak to internationally, also have an appreciation of what it is that, our portfolios really need. There's not much point in them bringing us additional tobacco stocks because we think we've got the best one in our portfolios already from a South African point of view. But there are interesting sectors and asset classes that might otherwise not be available to clients that we can do. The one point that I did want to make, and I think where we are a bit different from sort of what some of the peers and other managers, and I showed that on the valuation slide, is at the moment in a tactical point of time we do think South African assets are particularly depressed and offer attractive returns going forward. So in our multi-asset portfolios, we have not moved materially in terms of the offshore exposure as yet. Omri rightly points out that you get a lot of offshore exposure through some select names in South Africa. And we think these valuations on the local bourse are very attractive in absolute terms, certainly versus their own history, but also when you then compare it to the broader market internationally. South Africa has underperformed other emerging markets over the last number of years, and emerging markets as a class has underperformed developed markets quite significantly for quite some time. So just sort of tactically, you never know when these things change, but at this point in time, we see significantly better return opportunities by investing South African assets, whether that would be the bond market or actually specific stocks in our market.
And I mean, if I look at your asset allocations for compare and sort of contrast between M&G and Abax, we've got Abax at 35% SA equity, M&G at 45% SA equity, so that's a 10% difference. Abax almost 40% global, 32% in global equity, while M&G 25% offshore with 21% in global equity. So quite a big difference in positioning. Last question to you, Omri. I know you have to jump. Just quickly, your tech exposure, right? You hold Microsoft, Alphabet, Amazon, and I suppose I class Amazon as tech, particularly on the cloud solutions, Process, Tencent. Seems like you clearly believe that the tech growth play hasn't disappeared. Just your view on that.
Thanks, Leigh. Again, a good question. And I think a lot of those, what you'll see, a lot of that exposure is actually very, very recent. So those are high quality companies that we've always liked, but where the valuations were just expensive for way too long. And we've been kept out of it on a valuation basis. But what we've seen in the last, call it 9 months, you've seen a decimation in global tech. And it's indiscriminate. So your high quality together with your fly-by-night tech companies all got really sold down heavily. And I think that's enabled us to build positions in high quality cash flush franchises that still got some growth potential. So I mean, Alphabet, Meta, even some of the global, some of the Chinese tech shares, in addition to sort of Naspers process, where on an enterprise value basis, these companies have fallen by over 90%. So those are very extreme moves and fantastic value opportunities, and we've used that to on a limited basis increase our exposure. So we still look at what is the overall risk. So within the risk constraints, we've increased it quite significantly.
Great, thanks, Omri. And I know you have to jump, so thanks so much for your time. Leonard, don't jump yet. I've got a couple of questions for you still. Joe, while we're talking tech,
we'll only say nice things about Omri.
yeah, we can say whatever we want now about Omri. Actually, he's gone. Joe, I have to ask you this question. And for the audience, if you don't know, Joe is, he knows so much about Tesla, particularly, and quite a big fan around the whole concept of Tesla and the business itself. So, Joe, should Tesla investors be worried about Elon Musk's Twitter adventure? And is it a distraction keeping his hands on the wheel at Tesla?
Yeah. Yeah, thanks. Not sure how many people have the same sort of passion for Elon Musk and Tesla. I think he's better than anyone at dividing the sort of world into two camps, those that love him and those that hate him. Look, I personally believe, and it's more about Elon Musk than Tesla, that this is probably the most consequential individual of our time. And that will be reflected in the full sort of course of history. And companies like Tesla and SpaceX are just, a great demonstration of that. I think he's a very capable individual. So I have no concerns over the short term. He literally goes from an 80-hour week where he used to divide that sort of 40 hours Tesla, 40 hours SpaceX. He just adds another 40 hours, to his week, and now does 120 hours, which is a 40 additional hours at Twitter. So SpaceX and Tesla are no worse off, for him spending the time, at Twitter. And I think, as I said, a capable of individual. I think his biggest skill is probably getting the right people into the business. In order to get, whatever the project is sort of sorted out and running fine. And I think Tesla is, running absolutely fine. He's close enough in terms of Twitter headquarters where he's sleeping there, trying to sort out the problems, that he pops over to Tesla and does, his fair share of work there as well. So I don't think there's any problems. If anything, I would say the biggest concern would be just an individual working 120-hour weeks and putting so much pressure on himself. I think it's going to be a short-lived thing, but it's just the risk to an individual sort of burnout and, how much weight he's got on his shoulders, with not only those projects, I mean, just there's sort of side things he runs. In fact, there'll be an update called today on Neuralink, which is this brain-machine interface, and the Boring Company, just another two businesses that he's got in his portfolio. So I think Tesla investors should be absolutely relaxed about this. I don't think there's any issues.
Great, thanks, Joe. We'll hear a little bit more from Joe in a couple of minutes. Leonard, resource exposure. All M&G funds, at least the multi-asset funds, and equity funds hold Glencore, Sasol, Northern Platts, Impala, Exxaro. Maybe just explain the resource bit there.
Yeah. So look, I mean, it's been very beneficial to our portfolios over the last 18 months to 2 years to have this exposure. We've taken a long energy versus bulk commodities sort of stance in our portfolios, and that was before the energy crisis really became the front page news with Russia. I think there, we have done a lot of work on understanding the transition to cleaner fuel futures, which highlighted sort of the reluctance of investment in the energy sector for a number of years, since basically 2015, a big bust in terms of investment. So, we have a very firm view that the world needs energy and is short energy in a period of transition, because it clearly takes much longer to to build all the solar and wind, etc. power stations. So a lack of investment has made us optimistic on energy prices. We didn't foresee, you know, them moving up as strongly as they did due to geopolitical issues. So that's been the one part. The other side of that positioning has been on the bulk commodity side, where we've remained cautious on specifically the steel market and all their derivatives, so iron ore, manganese, ferrochrome, etc., which is a very large component to the Anglo's and BHP Billiton portfolios. So really being cautious on that stance, and you've really seen with the continuation of a zero COVID policy in China, you know, together, so lacking confidence from the consumer point of view, but also the property sector there coming under significant strain in terms of their sales and their own balance sheet. So demand for steel making type of ingredients is something that we remain cautious on. And so that was the first part of that trade. And then the second part, just in terms of the Northern and Impala, you know, when we observe the platinum group metal prices today, you know, the South African mines are clearly pivotal to global supply. The only large other supplier was Russia in the palladium market, so that's clearly become more problematic as a source of supply. So these companies are doing very well financially, so that's great for them. And it's great for South Africa from a balance of trade point of view, from an employment point of view, and all the secondary derivatives in the South African market. And so when we then look at this set of fundamentals and compare that to the valuations, the market is clearly discounting this Goldilocks scenario of not persisting for very long at all. So you're buying these businesses on extremely low multiples. Compared to, say, the gold sector, where, you know, they have more issues in terms of their profitability. Rising interest rates are not good for gold, typically as a commodity asset, and the opportunity set in terms of the gold mines. You know, those companies have pretty old assets, so they need to invest a lot. And there's a lot of gold out there in the world already. So again, we sort of juxtaposed those two sectors against each other, and, you know, it's quite amazing to us how stark the valuation differences are. And so that almost naturally leads you to the conclusion to position your portfolios in the way that you've mentioned.
Awesome. Thank you so much, Leonard, and thanks for joining us. I mean,
yeah, thanks very much for having me, Leigh. It's been a pleasure.
Yeah, it was awesome, and I will look forward to seeing you again quite soon. And good luck for the rest of the year. So yeah, I mean, ladies and gents, clearly two different asset managers with different ways of navigating these markets, but yet both proving quite successful in their strategy. So next is a presentation by Joe, a really interesting one about the importance of not being greedy or fearful, and really speaks about, you know, how and why our clients should stay invested during these really tough markets. So Joe.
Thanks, Leigh, and thanks. Simone's going to share the presentation and page through the slides for me. So thanks for that, Simone. This is so sort of topical, you know, when markets are volatile, and especially during market drawdowns. And I'll start with the quote by Warren Buffett, which, you know, I like. Our goal is more modest. So this was him addressing his shareholders at Berkshire Hathaway, the chairman's letter that he does annually. Our goal is more modest. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. And I think there's two important things that I'd like to unpack. That although he says the goal is modest, he doesn't say it's simple or it's easy. You know, he says it's modest, but they attempt to do this. And that's the part that makes it difficult for everyone, not only Warren Buffett. It's something that you have to attempt to do. So it's aspirational in terms of, if you can be greedy when others are fearful. In other words, when everyone's running from the market because the market's down so much, you know, that's when you stand to make the biggest, profits. And, I was watching a video of him talking about, this sort of concept of, most people, you buy something today, and if tomorrow it's cheaper, why would you think that's a bad thing? It's like better, you can now get more of it. So he loves it when, the shares go down, because it means he can just, if he loves the company, he can buy more and more of the company. But there's a reason that I'm not adopting this aspirational stance that he does. And if Simone, can you go to the next slide? And, it's because, unfortunately, we tend to act in the opposite way. Behavioral sort of biases have already been raised before, and we need to protect ourselves from that. And inaction is often seen as this vice, not a virtue. In other words, people want to be seen to be doing something, especially when markets are going down and they potentially losing money or losing, part of their wealth. They don't view it as being a sort of good strategy is do nothing, whereas actually doing nothing is a virtue. Now, we're not talking about doing nothing throughout the value chain. We've presented you with two asset managers that, are clearly very successful in their own rights. And the way we've combined those, hopefully you could see that, by winning those performance awards that, we've been successful in blending these managers together. So there's a whole pyramid, behind a solution of people running around doing many different things to ensure that you as the investor or you as advisors advising these investors don't need to worry about getting out of the market. And in fact, how detrimental that can be. Next slide, please, Simone. So, the way to sort of stretch our rand or our dollar as far as possible is, as markets go through these periods of turmoil, is to be able to capitalize on that. And that's what the underlying asset managers and our solutions, will be doing. So if you step out of the market through one of those processes, I'll show you how costly that can be, you're going to miss out on achieving that reality of achieving your goals. Next slide, please. So I'm going to show you just the S&P 500, the US market, and I'll show you the South African market as well. And this slide is dated, and it's on purpose because the market has bounced back since then. But, you saw a 25% drawdown year to date in the S&P 500. Fairly painful. I'll show you, if you look at the last 100 years, just how painful that is. It's not that bad, to be honest, but I know that, investors and advisors at 25% negative return, everyone would be worried about that and would be thinking about potentially pulling their money out of an investment that's going through that. So it's important to understand the context of how these markets move over time and why it's important to remain invested through these difficult times. Next slide will show you South African market. Nowhere as bad as the US market, so we were only down 14% year to date, but still painful. Now, most investors aren't invested 100% in equities. Here I'm showing you the all-share index. If you were in a balanced fund, maybe you were only down 5 to 10%, so not as bad, and hopefully less sort of painful to remain invested through these periods. So on the next slide, I view myself first and foremost as a student of markets. I really need to understand markets and how they operate and the cycles they can go through. And so market drawdowns are one of the things that I love studying and sort of analyzing. And I've got data, going back over, 120 years for various markets, over 25 markets around the world. And in this case, we're looking at the table on the right shows you the worst 10 drawdowns in the S&P 500 just since 1928. So you can see the worst one there being down 86% during the Great Depression. that's painful. Okay, losing 90% or close to 90% of your money, that's painful. But markets recover from these bottoms, and you can see that this latest one that I spoke about, since the war, etc., is only down 25%, which is 10th worst out of the worst 10 that we've seen. The COVID one was actually probably 10% worse than that, placing at 6th over the last 100 years, so down 34%. And look at that swift recovery that we saw. So first, if you're down 34%, you had to recover about 50% just to get back even. And if you had left the market when you were down 34%, you would have missed on that 50% recovery. But the market went on and gave you an additional 41%. So in total, on a compounded basis, 114%. So you would have more than doubled your money, if you had invested in the bottom, or if you had remained invested through that entire cycle, you would have been 41% up in less than a year, which is not a bad number. Now, clearly, no one knew what was going to happen in terms of, wars, etc. But, it just shows you how quick the recovery can be, and trying to time the market is one of the most difficult things, and therefore you shouldn't be doing that. Let's see, next slide. So I think, an important component to ensure that you can remain invested and not time the market is to have a plan and to stick to a plan. So as advisors, you'll know this better than anyone, sit with your clients, understand what their financial goals, their objectives are, put a plan in place to achieve those, make sure that the investments meet that plan, and that your investors understand, things like market volatility and drawdowns, and then just repeat that sort of cycle. Thanks. Next slide. And this is what we want to achieve at the end of the day, instead of the opposite, which is, if you were to be sort of fearful and greedy at exactly the wrong time, in other words, greedy when the markets have run substantially, you then get into the market, and then when they fall, you get out of the market. So it's sort of the opposite of what Warren Buffett was saying, aspirationally, what you should be trying to do. If you do this, you're going to go broke. And therefore, the recommendation is, don't try and be greedy and fearful. Don't be either of those things. Just put a plan in place and stick to the plan. And ultimately, that will help you achieve your goals. I think that's it. Thank you. Leigh, you're on mute, sorry.
I was going to say that in the previous slide, the bear market is not the enemy. Maybe Simone, can you show that again? Just stay there for a sec. The bear market is not the enemy, it's the opportunity. A pessimist sees the difficulty in every opportunity, and optimist sees the opportunity in every difficulty. From Mr. Churchill. So thanks.
Yeah, and that talks to, sorry, Leigh, that talks to exactly Buffett's point, right? When everyone is fearful because of the bear market, that's when you should be piling into it. I mean, we get these, sometimes once in a lifetime opportunities to invest fully in the market. The panelists spoke about having that dry powder so that you can deploy it when markets are down. It's the best buying opportunity. So, yeah,
absolutely. Thanks, Joe. While we have you here, I'd like to cover cover two really broad themes that are impacting, I think, the world today, not only investment markets. One is around technology, particularly around artificial intelligence, and the other ESG. So let's start with technology, right? We know that tech, and particularly AI, has come a really long way over the last few years. And I mean, that hasn't been sort of only to external industries. It's really been starting to impact investment industries as well. So whether it's been improving processes or decision making of asset managers, or just being part of of decision making. So not only improving it, but some are actually making decisions as well, you know, and maybe just a view on where this is all going, and some insights as to how our DFM makes use of technology to improve on our own processes.
Yeah, look, I mean, you mentioned sort of Tesla is one of my passions. The other one is probably AI and machine learning. I am a coder as well, so you know, I sort of hack around with these technologies myself. We employ them extensively within our own sort of business. A lot of the quantitative work that we do are these machine learning algorithms that you'll see being used, you know, throughout, you know, the world. By, as you mentioned, there's not one aspect of the world that isn't being touched by AI. It is really going through a revolution that probably started to a large extent in the last 10 years with the effectively convolutional neural networks, so on the vision space, but more recently, just the progress, and more recently, sort of 5 years plus, the progress that's been made around natural language processing has been absolutely phenomenal with these large language models. And the application outside of where you would think they would apply, you know, you'd think they'd apply just to language. So things like translation, summarization, you know, understanding, you know, all of these aspects that relate to language. A company like Tesla has taken that language model and applied it to something that's got nothing to do with language. It's deciding for autonomy, in other words, for cars to be able to drive themselves. You know, when they get to an intersection and they're going to make a left turn or right turn, and it's a multi-lane sort of problem, you know, you might be making, there's 2 lanes that can turn to the left, and the road that you turn into has got 3 lanes. You know, which of those lanes does the car needs to make those decisions by himself, right? The driver doesn't touch the wheel, doesn't say anything. He's using a language model to make those decisions. And you'd think, wow, what does that have to do with language? But you can tokenize, you know, a visual problem into a way that a language model actually understands, you know, what's possible. So what would be grammatically correct and what isn't possible. So, you know, it's just to say that to your original point, so many companies are being impacted by this. I mean, we're going to see a Nobel Prize probably being awarded, you know, to guys like DeepMind that have solved the protein folding problem with AlphaFold. You know, so you started off with this sort of AlphaGo, you know, beating the world champion at Go, and then AlphaZero that could not only play sort of Go and chess and any other game and beat world professionals, you know, but that same sort of thinking, that same sort of application being applied to one of the problems, the most difficult problem people thought in the world that would never be solved by computers, this AlphaFold, you know, protein folding has actually been achieved. And they've already won various awards for that. So it's touching every element of every business. Now, what makes it exciting for us, not only of the use of these technologies and how we can deploy them, is where our asset managers are thinking about this. And we've got one of our asset managers, our guys were out in the States 2 weeks ago, and we were on a call with them and just talking about these transformers, which is effectively these neural networks that are used in large language models and the impact they're having, and how they're doing research on, you know, which companies are going to be most impacted by these things, that they could translate those into investment ideas. You know, because ultimately that's what we want for investors, right? You've got this happening at all different layers. It's how can we use the technology? How can asset managers use these technologies, and the underlying companies, how can they use these technologies, and how can we make sure that they're in the portfolios for our investors?
Fantastic. I mean, I don't think anybody can get away from not using technologies to improve on our process and decision making. It's fantastic to know and understand sort of where we go in using particularly AI, machine learning to improve the overall quality of what we're doing. Last question, and like really quickly, we run out of time. Just so both of our previous managers hold BAT, right? British American Tobacco, but I'm not going to ask your view on ESG, particularly sort of the holdings, but rather just as a principle, is ESG as a principle congruent with managing money in times of high volatility and market drawdowns? Or is it sort of merely just a nice to have? And why I'm asking this is because there seems to be, and maybe it's just sort of what I'm seeing and reading, but less attention on ESG in the last sort of 6 to 12 months, and sort of, you know, more on just, you know, managing through these difficult times. So is ESG a principle that's congruent with managing successfully in high market volatility environments?
Yeah. So I don't think there's any sort of issue about it not being congruent. So that's the short and easy answer. And I know we are pushed for time, so I will keep it simple and just say that what tends to happen, just like we've spoken about, sort of stick to the plan and don't be greedy and fearful, is when markets are down, people are more sort of comfortable with abandoning some of these things like ESG when they're just hunting for returns. In other words, you know, bad returns hurt so much that if I have to go and get my return from an oil company, you know, let me go and do that, because those were the companies that potentially were the most decimated, for example. So it's not that it's not congruent, it's just that it might be a little bit more difficult to stick to these principled ideas, you know, through really difficult market times.
Fantastic. Thanks, Joe. Ladies and gents, we've come to the end. So in a nutshell, these new times require new solutions and new approaches, particularly to DFM solutions. And our solutions at INN8 INVEST is designed to be future fit, where these principles that we use of enhanced diversification, making sure we select the correct managers, whether they're boutique, whether their mandates are flexible, but really focused on sort of highly active managers in these tough environments. And we believe that this approach increases the probability of achieving investment outcomes, our clients' investment outcomes, and navigates uncertain markets with a lot more flexibility. So thanks for joining us. Have a wonderful sort of a few months till the end of the year. Keep safe, have a good festive season, and we'll see you in Feb for our next webinar. Thanks, keep well.